Hi, welcome to the Market Alert for Wednesday, the 18th of March 2020. So, helicopter money rears its ugly head once more. Sparks bond a backlash, stocks bounce on Fed bailout, but bank liquidity worsens, and it isn't going to improve either. Simple as that. But interesting to see that helicopter money could be on the way. The US government paying all of its citizens. As I've said many times in the Market Alert, the only way they're going to reduce the debt if they don't go for a reset is to inflate it, and the only way you'll inflate it is by giving the money direct, not to the banks, but to individuals who will go out and buy 17 screen TVs and spend every single penny, and thereby fueling the inflation that they so much crave at the Fed. However, they may have already passed the tipping point, and it may not work anyway. People would more likely hang on to the money now if they decide to do this. And the same in the UK. The Chancellor offering or creating out of thin air 330 billion yesterday for mortgage payments, etc. It would be better if we just divided that up between everybody and gave them the cash, frankly. But that's we'll go down the political route. But yeah, I think this sums it up brilliantly. It is a mad world, bonkers, frankly. But it's not the first time I've mentioned this in the Market Alert during the last 10 years. We're just now seeing it all come to fruition. The Dow is limit down. Can't create a chart in my own software because I need at least one tick of data coming through in the market that I'm looking at. So here you can see prices going limit down. This is a 1 minute chart. So once again, the Dow futures are down 1% and heading south, as you can see here. One other thing to keep in mind as well, you can see I've done a lot of trades over the last few weeks and had a ball as well, made good profits, 300 points the day before yesterday, 275 on Friday. But the spread betting firms, whether you can see this or not, you can. I normally trade the DAX in the morning. That's now 15 points. It used to be 1 point, and 16 points on the Dow. It's not worth being involved, frankly. They've just made life very difficult unless you're prepared to hold a position. But when you have prices effectively moving these price bars, when you actually see them, and this is in a 1 minute chart, and the low to high is 50 points there, 55 points, then the size of the stop losses are huge. And I've seen bars that are of 200 points in the last few days where you can't hold a position with any sort of decent money without having a massive fund and also being prepared to risk these initial costs. And at a pound a point, it's 15 quid straight in for a fee, 16 quid. They will narrow. This is the overnight, but they don't narrow much. It was 12 yesterday and 10 on the DAX after the markets opened. This is the pre-market spread, but if this continues, they will be the daytime spread. So yeah, pain, an absolute pain at the moment. Sort of taken the fun out of it because there is none, as we can't trade. I thought, well, if we've got to be confined to barracks, then at least I can trade, but not with these sort of spreads. It's making it more or less impossible. Okay, let's have a look at a few other things that are going on. Implied volatility has dropped, but not a lot, considering the Dow went up 1,200 points yesterday. This at 77% still, so not a lot coming off this, which is surprising. And there you can see the visual of it as well. We then move on to the bond market, the 2 and 3 month yield relationship, highest I've seen it since I've created these charts. These are my own charts, and as you've seen before, I actually plotted where the recessions were, what happened before the recessions. You can see there the inversion of the yield curve, and now we're seeing the explosive rise in the relationship, and then we get this, and then of course we get the full-blown recession, which I spoke about last year. This is not new to those of you that have been following for the last few years. Deutsche Bank is settled at the moment, but don't hold your breath. Just get rid of all of this. There's the 390. We had the 640 marked in for many months, but eventually it was broken, and we're still at 579. This is a dead cat bounce. Watch the 390 level. As Charles Nenner said, if we break 390, it's good night Vienna for Deutsche Bank. And what can I say about this? In Monday's market alert, I spoke about the gold-silver ratio. Silver has been pounded in the last few days, and frankly, wow, there is a trade that comes along once in a lifetime, and it's going to be the silver market. Let me just go back to this, and have I got a chart? I have a chart. Yeah. And I've started buying into this market. You can see here. This is not a recommendation by any means. I'm just disclosing the fact that there's two lines on the chart there. Yeah, the gold-silver relationship, as we've spoken of before. Let me just go back to it. I can find it. Here we go. So now we're over 120 pieces of silver for 100 ounces of gold. This has never been seen. It's never been seen before in the history of the gold and silver relationship, but we can see where it can come back to. And when it drops to these sorts of levels, what you're going to see is the underlying market do this. $50 is the high. It is a monetary coin. It is used in the monetary system and has been in the past. But at the moment, because of its industrial application being first and foremost, it's being pounded. And also, a lot of people are having to sell their gold in order to cover margin calls as well. So this shakeout in the silver market is a gift from the gods, as far as I can see at this point in time. And I've said this for a very long time as well, and actually recorded a video about this many years ago about having precious metals as part of any balanced portfolio of around 10% of assets. So we'll wait and see. But this is the monthly chart, so you can see that $50 in 2011 is the high. And that's the last crisis, the result of the effects after 2008, silver and gold prices rallying. These things are cyclical. But what you do is you get rid of the weak holders first, shake them out of the positions, and then you bring the market to the upside. And that's what we're seeing here. But this, if I hadn't have created this on Sunday, I spent all day Sunday looking to find something that would show unprecedented changes in the globe. And you can see there, Second World War, when we were at 99.73, 89.83 was the Gulf War. And then ever since 2011, after they slammed the silver price down to these levels down here, where we're currently at $13, you then see the effect of the gold-silver ratio taking years to get to this level. And it won't take us long to narrow. So the price of silver will increase hugely to catch up the price of gold as we go further forward in this crisis and crash. So I'll leave that one with you. Like I say, it is not a recommendation. This is for educational purposes only, to show you and highlight that in all of this, there is the odd trade that comes along. I mean, send it down to $3. That's fine by me. I don't care. Just, you can send it as low as you want with the old manipulation by JP Morgan and the other banks as well. Deutsche Bank fined $38 million for suppressing the price. JP Morgan waiting court action for suppressing the price, etc., etc. It goes on. So yeah, bring it on. Drop it as low as you want. It's fine by me. I will be quite happy to buy where I can see the floor, and the limited downside risk is a no-brainer. Simple as that. Okay, that will do it for this one. Let's see what happens today. Like I say, I'm not trading at the moment because those spreads are huge. Advised the same until we get some sanity back in the markets, whenever that will be. The implied volatility is indicating that's not going to be anytime soon. But forewarned is forearmed. Okay, that's it for this one. Thanks for watching. See you in the next one.